I've seen a company sell at $30 million where their three founders owned 75% combined. And those guys walked away with, call it $7.5, $8 million in their early 30s. That's a lot of money.
Welcome to the SaaS Builder Podcast. I'm your host, Randy Wooten, and today we're going to discuss capital structure and options for software companies. Joining me is Brian Parks, who is the CEO and co-founder at Bigfoot Capital, which provides non-dilutive growth capital for established B2B software companies as an alternative to VC or PE equity and debt. I know it's a lot of words. We'll get into it. Brian started as an investment banker, became an operator, and is now an investor in early-stage SaaS companies. Before founding Bigfoot Capital, Brian was the co-founder and CEO of Brandfolder. He was also an executive team member at two other startups in the travel and lending industries. We're going to start today's conversation by answering the question, what's the best way to finance growth at SaaS companies? Brian Parks, welcome to the SaaS Builder Podcast.
Thank you, Randy. Thanks for having me. Happy to be here.
Yeah, no, really excited. Love your background, being an operator and have seen it from both sides, investment banker. It just gives you a really broad perspective. And now as someone who's doing the funding, it's awesome. So maybe help us step back a little bit and just provide an overview for those who may not know about all those options, kind of what the financing options for SaaS founders is in order of the most to least common financing vehicles.
Yeah, most common I guess I'll speak to B2B software companies, which is where we focus.
Yes, exactly.
Don't have any experience in consumer, is angel and venture capital, like 100%. Those are the most common, have been, continue to be. And what we've been trying to do for a number of years now is provide additional options within a capital structure. And I'd say venture debt, which is not really what we do, honestly, at the end of the day, has been around for, call it 50 years, close to 50 years, since really the 80s. It's evolved over time as well. So that is a viable option, again, for companies that have raised an institutional venture equity round recently.
So can you draw the distinction there? Because people may not know. That was new to me, and I went out to raise venture equity and also in parallel was trying to raise venture debt from a different company. So why not just go to the bank and get a loan? Like you go to SVB, you get debt. What is the distinction of venture debt versus venture equity versus just go to the bank and get a debt loan?
Yeah, so venture debt is tightly coupled with venture equity in the sense that it's really not available if the equity is not there. So a prerequisite to get it is that a venture equity round has been consummated, and a fresh one at that. So let's say within the last 4 months, maybe. So sometimes it comes right alongside it. And it could be a nice thing to add to a venture equity raise. And really what it's meant to do is provide incremental runway. You may not even access it day one because you don't really need to, right? If you just raised fresh venture equity, you don't really need that runway extension until you may need it. And so it can be a nice tool to have. And there are venture debt banking groups, SVB and the like, that provide that structure. And there are some non-bank venture debt providers who provide that structure. Bigfoot Capital is a non-bank lender. And what that means is, we're not a bank. We are not regulated like a bank. We do not take deposits and have ancillary lines of business like a bank. Our kind of one-trick pony for making money is lending money. So I would say that I just said, hey, a bank may give you a facility and you may not need to draw on it because they've got your deposits, because they've got other ways of monetizing you, which is fine. From a non-bank standpoint, that doesn't really work because we need to get money out the door to make money. So we may give you some flexibility in terms of how you access the capital, but it is just going to be a little bit different than a bank.
Right, because you need the people to be using the money because they're paying the interest on the money, right? That's right. You're getting paid on them using the capital, so you want them to be using it. And would you say you're in the field, I've talked to people about revenue-based financing or ARR-based financing, so it's a separate motion than the venture equity, the venture debt, getting money from a bank. It's something different. And so talk a little bit about what that model is, because it's one of the less common ones, I think, but has a lot of flexibility and advantages, which we'll get to in just a second.
Yeah, great. And I would draw a delineation between kind of that ARR lending, which is what we do, and revenue-based financing, which is a different thing. And we've done some of that in the past, but we don't really do that anymore. So ARR lending, what is that? We are looking holistically at the business and kind of its fundamentals, quantitative underwrite, let's just say, what are the metrics, what does this look like? And as well qualitatively, what do they do? What's the product? What's the market? Things that equity investors care about as well. So we're not just simply, and I don't want to oversimplify what venture debt lenders do. I've never been a venture debt lender. But predominantly what they're doing is underwriting to the sponsorship. And when I say the sponsorship, I mean who the equity investors are.
Yeah.
Right? That is what they're doing predominantly. That is not what we're doing predominantly. That is a part of our overall underwrite. But yeah, we are an ARR lender. So we're purely lending against the revenue.
Sorry, so draw the distinction that you were making between ARR and revenue-based.
And revenue-based financing. Yeah, I'll get there in a second. I'd say what we're doing is we're sizing our loans and governing the availability under that. So we'll usually put forth a facility and say, hey, Randy, here's a $2.5 million committed loan facility, whatever the number is. You may not need $2 million right now. Maybe you only want to take $1 million. Maybe you're at 250K MRR. We're going to loan you 4x your MRR, so you can take $1 million. You're going to have to obviously grow your MRR to unlock the full $2.5 million, and we'll give you some time to do that. That would be the concept, right? Hey, you don't need all this money right now. Take some of it, can keep growing, put it to work. Honestly, you probably shouldn't take it if you're not continuing to grow. That's not a good thing to do. So anyways, that's the concept of ARR lending. Applying a multiple to the revenue to say how much debt you're going to give the company. Revenue-based financing, what that really is how the loan is repaid. So in a venture debt facility or in an ARR lending facility, generally there's going to be an interest rate and some fee structure. With a venture debt facility, there's going to be warrants. With an ARR facility, there may not be. We don't take warrants. We charge interest and some fees. Revenue-based financing is a little bit, it's like a royalty. That's what it is. It's a method of getting repaid. So there is no stated interest rate. You can impute an IRR, but what it's going to say is basically, hey, here's $1 million, and there's various flavors of it. I'll tell you the way we did it, which is a fairly vanilla way to do it. And we don't do that anymore. We just do term loans with interest rates. And there's reasons for that, which we can get into if we want. So here's $1 million. You are going to owe us $1.5 million back in 3 years. And the way you're going to repay that is we're going to take 8% of your cash receipts monthly. Okay? So when is that beneficial? That can be beneficial, in my view, in two primary ways. If you have extreme seasonality, and you may literally have months where you take in $0 of cash. For a lot of software companies, that's not the case, and for kind of selling SMB-oriented software or mid-market. But some sectors, to include like EdTech, for instance, EdTech has extreme seasonality. So a structure like that can make sense.
Sorry, so why would that make sense if they're taking money out each month, but there's seasonality? Or do what they say?
They're not taking money out each month.
Okay.
You literally may not receive any customer cash in the month of March, right? Therefore, you're not paying any payment on your revenue-based financing facility.
Got it. Mm-hmm.
However, you may get a deluge of cash in September, and then you're paying a very good chunk.
Because it's the percent of revenue.
Because it's a percent of the
variable
cash
based, or
receipts.
it's a percent of your cash receipts. And so
That's
as
right.
your cash fluctuates, you have a constant VIG of 8%, but it
That's
allows you to adjust for seasonality rather than interest payments every month of
That's right, that are fixed.
Fixed interest rate. Got it. So it gives you flexibility
so
on
it's just a different way of getting repaid. And there are different ways of doing. That's the most vanilla. And so as the lender, the RBF lender, revenue-based financing lender, is collecting under that schema, whatever you want to call it, methodology, they're working their way towards that return multiple over time.
Got it.
Right? Which may be 3 years for some. They may do 2 years or 5 years. If they do 5 years, they're probably going to want something closer to 2x their money that they put in. And it's really an IRR calculation. So there is no interest rate. And part of that's like a sales tactic.
There's an imputed interest rate.
Model it out, run an XIRR formula.
But I think that costs the capital, right? Basically, you're trying to figure out your cost of capital. So now, if we shift a little bit, so we've given a broad spectrum. There's more vehicles that people could access. How do you think, one of the things I really enjoyed about our conversation was like, Randy, what I'm here to do is help business optimize their capital structure. And so you're making choices around how much equity you take versus taking on debt as you're moving through different phases of scaling. What's your guiding principle there? And when you're talking to people, how do you help them think about optimizing their capital structure?
A guiding principle there, thank you for asking that, is where did I start my career? In investment banking. And that was not within the technology sector. That was lower middle market companies of other industries, fairly broadly speaking. And none of those companies had raised venture capital. Yeah, maybe some had raised angel money, and they shouldn't have. But I got to play a part in a lot of good outcomes. So these were people that had built their companies over the long term, a lot of commitment, a lot of grit, yes, had raised some capital and had a capital structure of some sort to include maybe bank debt or mezzanine debt or what have you. Options, that's important because those options have historically been underserving the segment of the market that we serve. a mezzanine layer of debt, even bank debt. That's not pure venture debt, right? And again, venture debt's tight coupled to venture equity, so you can't get it unless you have that capital. Venture equity has certain expectations for your business. And so those businesses were transacting in anywhere from $100 to $500 million. Those are pretty good numbers. And the people that had run those companies and retained their equity over time made a lot of money. And I'm like, all right, those are really good outcomes. And then I stepped
because clearly when you're giving up equity, you're giving up your upside. Whereas debt, you're taking on more of a financial obligation. Like you cannot get out of debt. If you shut down a company, you can get out of equity, right? The VCs write it down to zero. But the challenge is with debt, like you got to pay the debt. But you haven't given up control. You haven't given up. This is the point you're making. So these companies that were very successful that weren't taking equity in large chunks maintained control and had a big payday.
Yeah, in my view, they were successful. And then I think I stepped into software companies back in 2010, and it was only, I'm a finance guy. I'd been a finance guy, and then I jumped into companies and did a bunch of stuff. But it was just raise angel, raise venture. That was it. And that was all anyone within tech, and to a large degree, that was all that was available. And so that felt in the more when I raised equity, for companies I was involved with, for a company I started, I raised angel, I raised venture, I had a bunch of friends and peers that did the same. We were all doing the same thing. And you step back and you're like, man. And then you see a lot of outcomes that weren't good. And that is what's so pervasive and I think under-acknowledged.
More so today. I saw a post by Jason Lemkin from SaaStr writing about this. How many people do you know have made money? And because they're just chasing the valuation, gave up a bunch of the company, everything's getting crunched down. And if they do an exit, they're doing it as a recap and struggling. And for employee options specifically.
Yeah, exactly. I saw these outcomes in these companies that weren't tech companies. Then I came into tech and it started to be like, man, it feels really hard to have an outcome like the ones that I thought were successful. Because again, it's not interesting unless it's $1 billion outcome. And that's what we should understand. Yeah, it's only interesting for the venture capitalists and their business model, but like I think it can be very life-changing I've seen a company sell at $30 million where their three founders owned 75% combined. And those guys walked away with, call it $7.5, $8 million in their early 30s. That's a lot of money. That company had gone through Y Combinator, by the way, but they decided not to go down that path of let's raise a bunch of money. And they, sold to Atlassian. Like, great, that's awesome. I'm not saying any of this is easy to do. Brandfolder, the company I was involved in starting and was the initial CEO of, raised about $10 million of capital, $5 million of which was venture, got to about $15 million in ARR and sold for $150. And it flowed down all the way. The first AE, who it was great, and stayed at the company through the acquisition, and he made life-changing money for him. Was it 8 figures? No. But was it a lot of money? Yes. And I'm like, that's what I want to see. Yeah. And that was a $150 million acquisition and a $30 million acquisition that I said, 150, anything in between that. So let's get a lot more of those. Yeah. And I think those become much harder to achieve when companies are overfunded with capital that doesn't view those outcomes as successful.
Got it. Yeah. And I think when we were chatting before, what I took away was how not to have a capital structure that limits your options. And that's what you're talking about. It's optionality as you move through the different stages. You bump into some headwinds and what gives you some room to breathe. So to that point, when should SaaS founders start prioritizing fundraising?
Yeah, really good question. And I want to get back to debt just for a second.
Oh, okay.
You're right. Debt has to be repaid. I think in a whole blow-up scenario where equity is being totally valued, maybe it doesn't get repaid. It's not, we don't take personal guarantees. No one lending, for the most part, no one lending money to software companies takes personal guarantees. If they do, that's like out of market, seemingly. So it's not like it's following the CEO. It is meant to be repaid. That said, back to the optionality thing and not backing anyone into a corner or putting them onto a path that's hard to get off of, it's very important for people to understand and for us not to over-lever companies. Don't lend them too much, right? That is dangerous. And there have been a lot of companies that have been over-levered, predominantly I would say by venture debt lenders, because company raised an equity round 2 years ago. Venture debt lender said, great, and slapped on some. The way a venture debt lender is generally going to think about how much to lend is as a percentage of how much the equity raise was.
Right.
Call it 25 to 30%, whatever. But what's happened with a lot of companies, unfortunately, is they haven't performed well enough to raise that next equity round. So the venture debt lender doesn't really like it anymore. It doesn't fit what they do. They're assuming generally, hey, you are going to raise that next equity round. We're probably going to do something. We'll upsize it. We'll do whatever. When that doesn't happen, it's no longer a fit. So they're...
And I think to that point, Brian, because my last company, last company I was CEO of was called Percolate. We had Sequoia, GGV, Lightspeed, and first round capital. Top shelf syndicate, to your point.
Yep.
And when we went to get venture debt, the assumption from the providers that we were like Hercules and Silver Lake, the top folks that provide venture debt, they basically assume that the VCs are doing all the due diligence in terms of market, product, team, potential. And they do their own due diligence as well, but they're investing in the successful syndicate to say this is a viable category. The jockey and the horse are top tier, and they're gonna grow, especially in those early like seed, Series A, Series B. And so I do think, to your point, like the venture debt, or kind of if you can't raise more money, if you can't go out and get another round, clearly something's changed between the last round and this round, and we're not going to subsidize that, or we're not going to underwrite it if you can't get top tier investors to invest again.
Yeah, and I'm not even necessarily saying that's unfair. I'm just saying beware. And back to the over-levered thing. So who's going to get you out of that situation? Some other lenders, such as ourselves, may, but we're going to be very hard-pressed to if you're over-levered, because we're going to say, oh, okay, how much debt do we have to take out, and how much is that relative to their revenue? And I think oftentimes what we see is it's too much debt relative to their revenue to get it done. And so the company's kind of stuck in a somewhat precarious position. So back to... What was it?
Just for this, because I think there's really a interesting point that I want to close this section with is how can SaaS founders strengthen their capital structure, improve cash flow management, or make their company more attractive to potential lenders? One thing you said don't do is get over levered, because you get over levered and then you're stuck. You're a zombie company. You need to be EBITDA positive. The only way you're going to get out of that if your VC is a recap, in my opinion. You're going to have to recap the equity and then go through and figure something out. But to positively impact and to be on the right side of getting an appropriate level of debt, what's the thing that founders should focus on?
Really good question. To get the right amount of debt, is that what?
Yeah, or just to make them attractive to debt providers like you. If we've already talked about the venture debt lines up behind venture equity. It usually happens very close to a round. And what you do to get venture equity is, everyone kind of understands that. I was wondering, is there anything different that they would be doing to have someone like you that comes in with a different debt facility other than venture debt to make it attractive?
I think, look, for us, we're from a fundamental underwrite standpoint. Again, I'll step back and say, at the end of the day, these are pretty simple companies to analyze. We're talking about sub $15 million businesses that sell software to other businesses. And 75% of their cost structure is people. It's not rocket science. Now, what we have to understand is a handful of things. We're going to categorize, again, from the fundamentals, the revenue. That is our main collateral at the end of the day, and that's what everyone cares about at the end of the day, right? So we have to really dig into that and understand it well. And so I'd say from a company standpoint, it's important and very helpful if a company has very good kind of customer level and revenue reporting and ARR waterfalls and all the good things that folks like you help them with.
Unpaid advertisement. That's exactly what Maxio does. Is it helps with the rev rec, the deferred revenue, the ARR roll forward. Because to your point, I don't think people really appreciate it. When people are making investments, they want to invest in the product, but what they're buying is the revenue streams. And so they got to see that customers are buying. They're buying good gross retention, good net retention. They're buying more. But that if they have bad gross retention, it's a decreasing asset. And it just, so to your point, it's ensure you got good revenue and make sure you have it accurately represented. Because that's the other thing I find is when you go in to buy companies and they don't have good reports, that's the number one deal killer. If you can't be confident in what your ARR is, you're not going to create confidence with your debt provider.
That's right. Again, at the end of the day, that's what we're lending against.
Yeah, totally.
And so it has to be, we have to be able to understand it, and it has to be reported in a way that helps us understand it. That's absolutely right. When we think about, again, the category, it's kind of what's going on with revenue. How much is there? How's it growing? And then really what's the quality of it? The customer diversification. Where is ICP? And sometimes you get a cut through and say, okay, maybe retention looks like this on the whole, but there's a deeper story there of, hey, we actually found our ICP then, and you'll see. So you really got to do the work, and the company, frankly, has to be willing and able to help you do the work.
I think that's the other thing a lot of people don't appreciate, like an M&A acquisition, which I've done a couple and I've been acquired, is like when you go into one of those transactions, it is a for you, the CEO and the CFO, it's a full-time job on your full-time job of running the company, and you just got to be okay with it. And people are going to ask a bunch of questions, they're going to poke at stuff, and you just got to say, sure, here's what we got. You hope to have done enough diligence and work ahead of time that you got 90% of the answers. Good.
So I would say, let me just wrap that and answer your question.
Please.
Because it's not just about the revenue. It's holistically about the financial information and data around the companies. And retention really matters, Randy, as you mentioned. And even specifically, probably these days, gross retention. And really understanding that and being able to segment that and understand that. We care about capital efficiency. And, hey, what does that burn multiple, capital raised to ARR, things like that. We think about how can they service our debt, right? And there's certain metrics we'll look at alongside that. Yeah, having clean information reported and that you as the CEO or CFO really understand and can speak to is paramount.